Okay, welcome to 10-3, Explain Determining Accounts Affected by Closing Entries. Well, the very first thing we should need to do is just review very quickly what accounts get closed and what they get closed into. And we'll do that at the very bottom here. And we know that the revenue account gets closed into the income summary, right? And we know that the expenses gets closed into the income summary. And we know that the income summary gets closed into the capital. And then the withdrawals get closed directly into the capital. So these are the accounts that are affected by the closing activity. Revenue, expenses, income summary, withdrawal, and don't forget capital. So very quickly, it's asking us to identify what financial statements are affected by closing these accounts, what reports that they do appear on, and whether it appears on whether it's affected by closing entry or whether it's on the post-closing trial balance. Now, I went to the textbook and I pulled out an example of what a post-closing trial balance looks like, and from what I can see, there's only permanent accounts on there. So we have our assets, right? Let's see, Tupperware, we have assets. I think a red might be better. Assets, we know our liabilities, let's see, two payable accounts, and we know we have our owner's equity. So here's assets, liabilities, and owner's equity. So there you go. So you could very quickly go through and say, well, will they be on the post-closing trial balance? Is it a permanent account that's listed on that top post-closing trial balance? Well, you would say receivables are, so I would say yes to that. Expenses, niente. Cash and bank, yes. Revenue, niente. Equipment, yes. Income summary. Do you see an income summary on there? Remember, it's neither. It's a temporary account, but it's got a very different characteristics than a expense, withdrawals, or revenue. So we're going to say no to that, and we're going to say equipment. Yeah, I would say that's on there, and we would say expenses. No. More fees? No. Expenses? No. Furniture asset? Yes. Expenses? No. Tools asset? Yes. Capital? You see capital on there? Absolutely. Yes. Withdrawals? No. And then expenses again? No. So the checks mean yes, the X's obviously means no. Is it affected by a closing entry? Well, what accounts get closed? So we can say the capital, revenue, expenses, income summary, and withdrawals. Is this receivables? No. Expense? Yes. Cash and bank? No. A revenue? Yes. Equipment exercise? No. Income summary? Yes. A big yes. Laundry equipment? No. Expense? Oops, put an X there. And then you say maintenance expense and fees. We're going to say yes to both of those. We're going to say miscellaneous expense? Yes. Office furniture asset? No. And the rent expense? Yes. Tools asset? No. Capital? Well, don't forget the capital. Right? Sometimes you skim right past that one. You would say yes to that. Withdrawals? Yes. And expenses? Yes. So X's mean no, checks mean yes. What financial reports are these going to be on? Well, the two options that we have are the balance sheet and the income statement. Well, let's keep it simple, folks. What is on an income statement? Well, go to the example that I have here. It's sort of a segment of a 6-column worksheet where it does show you an income statement and a balance sheet. So we're going to go with, well, let's say revenue and expenses, number 1, and expenses. And what's the other one? Is the income summary listed? And we're going to say, well, it's not really on there, is it now? I would say we're going to just say leave that blank, okay? So let's go right to the income summary and say, no, let's put a dash there, leave that empty. So what you're going to do is, if it's not a revenue and it's not an expense, you're going to say balance sheet. The only temporary account that shows up on the balance sheet is the withdrawals, because that's the quickest way. It's neither an expense nor a revenue that affects the capital. So the quickest way of devaluing your company is to take cash out of it. All right, so let's go with, we will call these income summaries, or excuse me, income statements. Expense, we're going to say income statement. We're going to say cash and bank. Revenue, income statement. Cash and bank, summary, equipment, expense, income statement. Fees, income statement. Remember, fees are revenue. Okay, don't get hung up on that. Expenses, income statement. Furniture, that's an asset. Or rent expense, income statement. Capital, no. Withdrawals, no. And then expenses, income statement. Everything else is going to go on the balance sheet. So you would say all the permanent accounts, including the temporary account withdrawals, goes into the balance sheet. So everything else is going to be balance sheet. I guess you could say everything else is BS, right? So here we go. There you go. Balance sheet, and balance sheet. That answers the question that we have for 10-3, determining accounts affected by closing entries and what financial statement they belong onto, whether they're affected by closing entries, and whether you'll find them on the post-closing trial balance. And you're going to say an emphatic, well, you're going to say only permanent accounts show up on the post-closing trial balance, because everything's been zeroed out for the beginning of the next accounting cycle. And then we're back to step 1 again. So that concludes 10-3. And let's see how much time we have. 7 minutes and 12 seconds, and we're going to call it a day.